All right, let's get straight into our analysis of Huaxing Technology. We're going to deconstruct the strategic positioning of this company, which has become a really pivotal player in the semiconductor equipment space. Our focus today will be on its market dynamics, its strategy, and of course, its financial trajectory. So, what's the core thesis here? It's really that Huaxing's story isn't about just one thing. It's about the powerful intersection of two major long-term forces. On one side, you have the global AI revolution, which is creating huge demand for advanced chip packaging. And on the other, you have China's strategic push for a self-reliant semiconductor supply chain. Huaxing sits right in the middle of this confluence. Okay, so to really understand how Huaxing got to where it is, we have to go back to its foundation. And that foundation is all about mastering a process called nanoscale polishing. So what exactly is chemical mechanical polishing, or CMP? Well, you can think of it as an incredibly precise sanding and polishing process for semiconductor wafers. It uses a chemical slurry combined with mechanical force to flatten the wafer surface. And we're not talking just flat. We're talking about a level of precision down to the nanoscale. It's absolutely critical for modern chip making. Here's a great way to think about why this is so important. Imagine you're building a skyscraper. Each time you add a new floor, the one below it has to be perfectly, absolutely flat, right? It's the same idea with modern 3D chips. You're stocking layers of complex circuitry, and CMP is the process that ensures each floor has that perfect nano-level flatness. Any tiny bump or imperfection could ruin the entire chip. And for a long time, this critical market was essentially a duopoly. You had the American giant, Applied Materials, and Japan's Ibara. Together, they controlled over 90% of the entire global market for this equipment. So you can imagine, the barriers to entry were just massive. But this is where Huaxing's story really begins. They managed to break into this market specifically within mainland China. And they did it fast. Look at these numbers. Their share of the crucial 12-inch CMP equipment market went from just 21% in 2020 to an estimated 47% by 2022. That's a huge shift, establishing them as a key domestic supplier. All right, now let's talk about the accelerants. What are the macro forces, these dual engines that are really fueling the demand for Huaxing's tech? And this brings us back to those two powerful drivers we mentioned at the start. On the left, you've got the global AI technology wave. The incredible demand for things like HBM and CoWoS packaging for AI chips creates an exponential need for equipment like Huaxing's. And then on the right, you have China's strategic imperative, this national goal of building a secure semiconductor supply chain, which creates a stable, predictable, and frankly, protected market for domestic leaders. And just to put the scale of that AI opportunity into perspective, the global market for advanced packaging is projected to grow from around $38 billion in 2023 to nearly $70 billion by 2029. That's almost a doubling in just 6 years. This isn't a short-term blip. It signals a sustained, powerful demand driver. So what's really interesting here is that Huaxing isn't just sitting still on its success in CMP. The company is making a very deliberate strategic shift. It's evolving from a single product specialist into a much broader, diversified equipment provider, a platform. And this evolution is happening in very clear strategic steps. You can see the logic. Step 1, dominate your core market, which for them was 12-inch CMP equipment. Step 2, use that dominance to expand into adjacent areas like wafer thinning and dicing, which are critical for that advanced packaging we just talked about. Then you broaden the portfolio further, in this case through an acquisition in ion implantation technology, and finally add even more capabilities. It's a classic platform building strategy. And this quote from the source analysis really captures the essence of this shift. The company is no longer just seen as a specialist in the CMP field, but is evolving into a diversified semiconductor equipment platform. Now, why is this so crucial? Because it fundamentally changes how you view the company's potential. It expands its total addressable market by billions of dollars, moving it way beyond just a single niche. And this illustrates another key part of the strategy, the equipment plus services flywheel. You see, the more equipment you sell, the larger your installed base becomes. And that installed base then generates a steady, high-margin, recurring stream of revenue from services, spare parts, and things like wafer regeneration. As you can see, that's already about 14% of revenue, and that piece of the pie provides a really stable and profitable foundation for the entire business. Okay, so we've covered the strategy now. How does all of this translate into the numbers? Let's take a data-driven look at the company's financial performance and the projections from the report. All right, let's break down the DuPont analysis here. What this does is deconstruct the return on equity, or ROE. And what you see is a clear projection of ROE improving from 14% to over 19% by 2025. Now, what's driving that? It's primarily the first line. Net profit margin is expected to tick up, which points to strong core profitability. At the same time, asset turnover, how efficiently they use their assets, is stable, and the equity multiplier, or leverage, is increasing moderately, likely to fund all this expansion. So it's a margin-driven story. Now, looking at the top line and bottom line projections, you see a story of continued strong growth. Revenue growth is projected to remain robust in that high 20s to mid 30s range. But the really interesting number here is that net profit growth figure for 2026. You see that jump to 57%? The analysis suggests this is an inflection point, where those new product lines we talked about, like ion implantation, are expected to really start scaling up and hitting the bottom line. Of course, no analysis is complete without looking at the other side of the coin. So now we need to take a balanced view and really dig into the potential risks and challenges ahead. So here's the analytical debate summed up. The bull case is pretty clear. You have a domestic market leader in a critical technology that is successfully expanding into high-growth, AI-related markets, all while being supported by a strong national strategy. The path to growth seems well-defined. The bear case, on the other hand, centers on a few key concerns. Is the valuation already too high, baking in all this future growth? What happens if competition intensifies? And are there risks related to recent executive turnover? Let's get more specific on those risks that need to be monitored. First, there's technology and competition risk. There's still a technology gap with the global leaders, and you could see other big domestic players trying to enter the CMP space. Second, there's execution risk. Can they commercialize these new product lines, like ion implantation, on schedule? Third, customer concentration. The company is highly dependent on just a few large domestic foundries. And finally, you have valuation and governance risks. The current valuation leaves very little room for error, and recent management changes always raise questions about strategic stability. And that brings us to the final, bigger picture question that this whole analysis raises. When you look at the global race for semiconductor supremacy, what's the winning model for the next decade? Is it going to be the domestic champions like Huasing who are leveraging protected markets to grow and scale, or will it be the established global giants who continue to lead with cutting-edge technology? The answer to that question will likely define the entire industry for years to come.